In this example, I'm using a more complicated case to review the cost assumption LIFO and FIFO under two different inventory systems, periodic inventory system and the perpetual inventory system. First, we should keep in mind when we apply cost assumption, we're also using periodic inventory method. So before we start, let's first organize the information we're given. So this firm has the balance on June 1st. The number of units is 301. So this is considered as beginning balance. Number of unit is 301. There are two purchases. One is on June 11th. The other is on June 20th. So number of units for the two purchases is 1,300. So the number of units available is 1,601. There are three sales, which on 10th, 15th, and 27th. So the number of units sold, if you sum all the three, they are 998. Ending balance of the inventory will be 603. Now, the first one is LIFO, last in first out, the cost of goods sold. Basically, is to calculate the cost of inventory, total 998 units sold. This is all the goods available during this period. Last in first out, this is last in, so it is first out. So 502 will be sold and the price is 19. Total 998 out, so we still need 496, and 496 must from the cost per unit is 17. So cost of goods sold is 17,970. The ending inventory, the number of units sold of the purchase on June 11th was 496. There will be 302 left. Multiple 17, and the beginning balance 301 is still left. So that's 14. So cost of goods sold, also the ending inventory is 9,348. Next one is FIFO, first in, first out. We are using periodic inventory method. The total number of units sold are 998. 301 will be out first. We still need 697, which is from the first purchase. The cost is 17. So the cost of goods sold is 1663. The ending inventory, which was left, will be 798. The first purchase subtract the number of units was sold, multiply 17. And the last purchase is still considered part of the ending inventory, is 19. So this is 101 multiple 17 plus 502 multiply 19. And ending inventory is 11,255. Periodic inventory system is very straightforward. We just only consider all the units sold. We don't need to consider whether the sales is before the purchase or after the purchase, because we consider all the inventory available in this period. The next one is perpetual inventory system. First, LIFO. For the perpetual inventory system, we should track the timing of the purchase and sales. Total number of units sold is 998. We should consider them separately because the timing of their sales may be before or after some purchase. So cost of goods sold, LIFO, last in, first out. The first sale is on June 10th. On June 10th, we do not have information about the purchase after the June 10th. So this is only inventory available. So this inventory is the beginning balance of inventory. This is only inventory available. So 197, which is sold, will be $14. The second purchase, there are two inventory available. One is unsold inventory from the beginning, and this purchase. And the purchase on 11th is the last in, so it will be first out. The 502 should be from purchase on June 11th. The cost is 17. Last sales, which is after all the purchase. Now we have last purchase, the unsold beginning inventory, and unsold the first purchase. Because the purchase on June 20th is last in, so it should be first out, right? So the $299 would be from the second purchase, $19. The cost of goods sold is $16,973. The ending inventory actually is the 301, the beginning balance. This is the units sold, so this is what left. Price, the cost is 14,798. Subtract the inventory sold, 17. Last one is 502. Subtract the inventory sold, multiply 19. So the end inventory will be 10,345. So last question is perpetual method, FIFO. We are asked to calculate the gross profit. Gross profit equals the revenue subtract cost of goods sold. And we have the number of units sold and also their price. So we can calculate the revenue is 197 multiplied 34, 502 multiplied 36, and 299 multiplied 39. The total revenue is $36,431. Next is cost of goods sold. Because FIFO, first in, first out, using perpetual inventory methods. The first sales is 197 units. On June 10th, the inventory available is the beginning balance. The cost of goods sold is 197 multiply 14. The next one is 502. Because the first in, first out, the beginning inventory, there is only 197 were sold. So actually there will be 104 units left. The cost of beginning inventory is $14. We still need 398 because the second sale including 502 units. This is from beginning inventory. This should be from first purchase. The cost is 17. Last one, 299. The second purchase including 798 units. 398 were sold. There will be 400 left. And this 400 is greater than the last sales. So the 299 are all from the first purchase. So the cost of goods sold is 1663. And if you compare this number with the FIFO periodic, got same number. That's also what I conclude in the PowerPoint. FIFO for periodic and perpetual inventory system are the same. Since we have revenues and cost of goods sold, we can easily get the gross profit, FIFO perpetual equals 20,360. From this example, we learned both the inventory methods and the cost flow assumption have impact on the firm's earnings. So that's why when you read their financial statement, you should check their notes, what assumption and methods they apply.